Hello, everybody. Welcome to episode number 19 in our series of write-offs for real estate investors. And this is an episode that we were not necessarily looking forward to because it kind of goes into the dark territory of what, interestingly, is my occupation, like my profession is fighting Uncle Sam, beating him up. That's why I wear my red gloves, and that's where my black belt, which is right here, my black belt in real estate taxation comes from. Okay, so what we're talking about today is IRS audits, and we traditionally go through three sections with Bernard. We go through benefits, gotchas, and execution. And as you can see on the slide right now, for the first time, benefits area is empty. We brainstormed it for a while, trying to figure out, can we come up with some kind of benefit related to IRS audits? Well, we failed. We cannot come up. That's part of life. That's something we need to deal with. And what I want to ask you, Bernard, is this. One of the specialties of your firm is cost segregation. Cost segregation, as we discussed in the cost segregation episode, dramatically increases losses and consequently reduces taxes for many investors. But also as a side effect of that, you know how you read your drugs, like your prescription instructions, there are side effects. One of them is always death. So, okay, you can die from that, but other than that, it helps you, right? So the benefits of cost segregations are tremendous, but one of the side effects of that, unfortunately, is, well, fortunately, is not death, but unfortunately, it is a much higher risk of an IRS audit because it's what we call an audit flag. So what do you tell your clients who come to you and saying is, yeah, cost segregation, all of that sounds great, reduces taxes, but I have heard that now I am a walking target for Uncle Sam. What is your response?
So there are multiple responses for all of these things in general. Now, incidentally, we don't find particularly high audit risk related to having a cost segregation study. But secondly, and most importantly, the world of taxation is really all about making smart tax moves that are correct and defensible and upright, and avoiding tax moves that are fraudulent or not straightforward. If somebody really wants to be audit proof, perhaps they shouldn't invest. So anytime you run a business, you invest, you're creating tax documents, and theoretically having a business is an increased audit risk. Investing in real estate, investing in anything, right, creates an increased audit risk. The key is to run your business and do your investing in a manner that is in line with your values and in line with what Uncle Sam allows. You can have a level of aggressiveness on your tax returns and tax positions, but you want to stay out of the realm of where you can get into trouble for it. So that being said, a cost segregation study, in our experience, even when it has been audited, we have not had any issues. And a lot of it is really Uncle Sam wants to see that you did it correctly. And that even in a superficial way, it looks right. So if Uncle Sam looks at your depreciation deduction and said, where did you get these from? And you say, I did this on the back of a napkin. Uncle Sam says, let's take a deeper look. But if you say, here, I have a study from a reputable firm with professionals, Uncle Sam says, you know what, this looks good. Let's pass. It's not worth our time. So a lot of it is about, number one, staying within the rules, because cost segregation and many other tax strategies are in the tax code and they're there for you to take advantage of. And Uncle Sam even tells you what they're looking for and how they want you to do it. And secondly, you want it properly documented so that it looks right. And Uncle Sam says, hey, this guy plays by the book. He's done things, he's got backup. Let's focus on better targets.
So I want to pick up from like on that thought and expand it a little bit. So one is you commented, and I completely agree with what you said, Bernard. Okay, so my continuation is this. You mentioned that you did not find cost segregation to cause audit problems. Okay, there are two comments I want to add. So cost segregation itself is not something that is but where it comes into play is a lot of people who do that claim real estate professional status in order to fully benefit from that. And real estate professional status is a major audit flag. Cost segregation just essentially being part of that whole situation. More importantly, is what you discussed were two sides of an IRS audit. One is what leads to that, or what triggers an audit. The other one, what actually happens when the audit is already initiated. So strategies that we discuss throughout episodes, such as real estate professional status, such as 1031 exchanges, such as STR loophole, and some of the other strategies that we were talking about are audit flags for Uncle Sam, which means your probability of him looking at that is higher. Why is it higher? Because he says, okay, normally when you have W-2 income, you are expected to pay that much in taxes. But on your tax return, for some reason, your tax is much less. And that reason is, of course, one of those real estate strategies. So would it likely draw the attention of Uncle Sam? Yes. But what Bernard was explaining is, okay, so what? If you have done it correctly, done it professionally, have your documentation, have your records, then when the audit happens, it does not mean that there is trouble down the road. There is hassle, there is an extra cost if you hire representation, there is time wasted, there are unpleasant feelings, all of that. But are you going to owe more money to the IRS after that? Not particularly likely if everything that you have done is up to the rules, if you follow the rules and have good documentation, which Bernard, if you can show us the next slide, ties into the gotchas, and the gotchas says this, okay, that is assuming, I said like, you're not likely to have problems. That is assuming that the person you are dealing with on the other side, known as the IRS auditor, is competent and understands the rules that we were talking about. Okay, newsflash, most of them don't. What IRS auditors are trained on is bank reconciliations. They are very good at adding up all of your deposits, comparing that to numbers on your tax return and saying, it looks like you had more money coming into your account than what you reported as your income. Please explain the difference. That is what they are very good at. But talking to them about STR loophole or real estate professional status is not necessarily that easy, because they are not well trained. They are not trained in the tax law. They are more trained on the procedures. So does it mean you lose? No. What it can mean is that you might need to go higher level at the IRS and deal with better trained, more experienced people, such as people who work at the IRS appeals level. And before we go to execution, let me go through a few topics related to IRS audits that is subject of discussion, particularly at the time now as we are filming those episodes in early 2024. So some of the issues that I hear being discussed all the time is, well, I haven't heard of anybody audited in the recent time. You know what? I haven't either. Because in the recent times, we had 3 years of COVID and post-COVID reaction. During this time, the IRS was preoccupied with different problems, with a backlog of email, with trying to figure out how to move all of their workforce into remote operation, with their awfully inadequate, antiquated information technology and all of that stuff. There was pretty much zero audit activity, and even collection activity for IRS debt was very, very minimal during the last 3 years. But if you have observed how US government operates, it swings from one extreme to another. What most tax professionals, most of my colleagues expect right now, and we are already seeing the signs of that in real life, is complete swing from no audits to a lot of audits. We don't have reasonable middle. We go from one extreme to another. There are audits happening now. There are a lot of IRS letters that our clients started to receive as we speak, and that activity from industry expectation is going to sharply rise in the near future. Be prepared that the bear is no longer hibernating. You know, the bear is fully awake, and don't poke him because he is awake and the problems will start happening. So questions that people ask all the time is, okay, when is the audit happening? So right now, we're filming this particular episode in April, almost April of 2024, close to April 15th deadline. This is when many of you guys just finished filing your tax return for 2023. And you're saying is, well, the IRS said my return has been accepted. I received my refund. I'm fine. No, you're not. You're fine as far as your refund, but where I'm not fine is probability, or better say, chance of an audit. This is because audits do not happen right away. And you being issued a refund does not mean that the IRS later will not look at your return. The timeline for that generally is 1.5 to 2 years after filing. So if we're talking right now, we are in the middle of like first half of 2024. Add 1.5 years to that. So if you hear from Uncle Sam that he decided to audit you, it's highly unlikely for your 2023 return to happen this year in 2024. When you might hear from him is not early 2025, maybe late 2025 is when a letter can come from him saying is, hey, guess what? We want to look into your things. Can it happen in 2026? Yes, it can. So you have heard that generally, it's a general rule. There are some exceptions, but generally the IRS have 3 years to audit your return. Do they have more time? Actually, they do. But in most of the cases, it's a 3-year window after filing. What is super important to do during this period of time? What is super important is keep your records. I have heard from some investors who said, okay, my return is filed. I don't need these records anymore. Oh, no, you do. For the next 3 years, he can come after you, really more than 3 years. But at least for 3 years, he can come after you and ask to want to review your tax return. And that's where you will need all of your records. So by no means you can discard them right now. And the question is, so for how long do I keep them? Our advice is 3-part. The simple part of advice, at least 3 years after you file. Second part is more complicated. If you sold the property, it's 3 years after that property was sold, but that includes the lifetime of the property. Here is what I mean. If you sold a property that you held in 2023, that you held for 10 years, if you are audited on your 2023 return, not only you may need your HUD statement, your closing statement from the sale of that property in 2023, but you might need the closing statement, a HUD statement from the purchase of that property 10 years back, and all of the improvements you did in the meantime. So records related to properties, all of the records related to a property should be held for 3 years after it's sold. Okay. And the third final part is, well, really, if you want to be super safe, I recommend that you double 3 years to 6, because technically in many cases, IRS has 6 years. It's very rarely executed, rarely they go past 3 years, but they can. So it's a prudent policy if you keep your records later. But I don't have room. Oh, come on. All of the records nowadays are electronic, scanned into your computers. Long ago in the past, the IRS was hesitant to accept scanned documents. They tried to reject them and require paper documents. Those times are in the past. Right now, your scans, your electronic records are fine. That's how you should keep all of that. Okay. Now, who can help you with that? There are, if the IRS is
Michael, if it's okay.
Yes, that's exactly the question I was going to throw your way.
So I wanted to just jump in and mention the 3 and 6 years that we're discussing is not from the date of sale of the property. It is from the later of the tax filing due date or the actual filing of the return. So if you filed your return, if it's due, if you sold your property in June of 2023, when we measure the 3 or 6 years, at a minimum, we're measuring from April 15th, 2024. If you filed your tax return after that, you had an or late, the 3 years begins from the tax filing due date. So make sure you're measuring the 3 and 6 years from when the IRS measures it. It's not from the transaction. It's based on tax filing.
Good correction. Okay, so now can you comment on that? So many people, and that is in the part of execution. Okay, so many people choose those last 3 letters of that statement, which is do it yourself, DIY. So what is your comment about that versus using professionals like myself to represent you?
So if I had to sum it up, I really would say always use a professional, and I'll explain why. I'll speak about when DIY could theoretically work, but I'll also explain why I think it's probably always a good idea to have a representative. So the key to any type of dealing with any type of audit is having good records. So it's not only about saving those records, it's about the quality of those records. It's about creating quality records and then preserving them. So if somebody created great records, which we'll talk about episode 20, we'll talk about CPAs, EAs, bookkeepers, other real estate tax professionals that you want to have on your team. But assuming you created those great records and you understand them, and any line of the tax return, right, the IRS will say, hey, line X of the tax return, explain to us where that number came from. If you have the documentation, the records, and the understanding of the records to show the auditor exactly where that came from, you can DIY. However, the reality is that for many, many investors, and even the best of them, in the face of an IRS auditor, that is easier said than done. So it goes without saying that if the records are not pristine, or you don't have a very solid grasp of how those records tie into the tax return, you should hire a professional. But even if you do, I think it's always a good idea to have a professional in standing between yourself and the IRS auditor. You simply have experience of dealing with an auditor, knowing what to say, what not to say, is invaluable. So even the best of investors, in terms of those that have a solid grasp, would want to have a professional sit between them and the agent. Can you DIY? Yes. Do I think you should always have a professional? Yes.
Let me develop that thought from the perspective of somebody who actually does represent people in front of Uncle Sam. So we're going to talk about different types of tax professional in the next episode. But my particular license is called EA, which stands for Enrolled Agent. And the Enrolled Agent license specifically authorizes people like me to be sort of your attorney, like represent you in front of the IRS and be your advocate in the case of audit or any other IRS issues. Now, Bernard just said that he believes it's always a good idea. I agree it would always be a good idea, except there is one thing that stands between that, and that's cost. So hiring somebody who has a lot of experience beating up the IRS with red gloves is not cheap. So where you have cheap option to have representation is if you are doing your taxes on TurboTax, and TurboTax comes with audit insurance option. You can pay a few dollars extra, it's under $100, and they promise to represent you in front of the IRS. Are they going to do it? Yes. Are they going to do it with real effort that is required there? No, because they don't have the resources to do that. For the cheap audit insurance, what you get is they spare you from having to talk to the IRS, but all the work that goes into your full representation is not budgeted into that insurance. Now, hiring somebody who is full service representative like me, for example, is costly. So what you always have to look at is comparison. How much money is at stake and how much money you would have to pay your representative to defend you. Here is an example. And those situations annoy me as a tax professional a lot because many of those 800 companies that you see advertised on social media, you know, on TV, have this very, in my opinion, unethical model. They're saying, oh, you have an IRS audit here, okay, sign the contract, okay, here is our 9,000 fee, paid and we'll defend you. Okay, question is, how much money is at stake if you lose an audit? Let's say 10,000. Okay, does it make sense to pay somebody 9,000 to potentially save you from 10, considering that they cannot guarantee you the fact that they will save you that 10,000? It's a very dubious proposal. You know, I would be very hesitant to do that without guarantees. So what does it mean then? Do you just concede, you know, roll over and concede the 10,000 that he wants from you? Well, as harsh as it sounds, in some cases, maybe that's an option. In other cases, you will do what we just discussed, try to do it yourself. But you can, and can you do it yourself? Absolutely. I personally know many people, including our clients, who chose to face the IRS on their own and emerge victorious. It's totally possible. What you need to have for this is good records, good control of yourself, good ability to represent your facts and argue on your behalf, which, by the way, are all essential skills for a successful real estate investor, regardless of whether they deal with the IRS or not. So is it possible? Yes. Is it the best route to take? Depends on the situation, depends on how much money is at stake, how difficult is the case, how good or bad are your records, how much time you can afford to devote that. All of these factors dictate different outcomes. But what I want to close that episode on is a very, very important, like the most important, I guess, message from this episode is IRS audits are part of being a real estate investor. If you're in this business, just like, roof leaks, tenant problems, contractor problems, guess what? IRS problems is another one in that long list of problems you have to deal as an investor. Don't try to hide from those problems. Don't overreact. Don't panic. They are part of the business. And as long as you are not intentionally and blatantly ignoring the IRS rules, such as, for example, claiming real estate professional when you know you do not meet the criteria. I never recommend doing that. Or claiming deductions which you did not pay for. This is fraud that not only can cause an IRS audit and money spent, money owed to the IRS along with interest and penalties. But in some extreme cases, it can cause criminal prosecution against you because that would constitute fraud. So as long as you are not committing fraud, part of being like exposed to an IRS audit is part of the business, and what you need to focus on is following the rules and having good records. So, Bernard, if you don't have anything else to add, we are done with this episode.
Yes, no, I think this is, we were groping for a benefit. There is no benefit to an actual audit, but there is a great benefit, not only from a tax perspective, but also from a financial perspective as an investor, to having good records, to know your income, to know your expenses. And for better or for worse, the possibility of an audit can be the catalyst to keeping good records, which will serve everybody well financially as an investor, knowing where you stand, how is your property performing, and to be actually sleeping well at night. So while there's no benefit to an IRS audit, and hopefully none of our clients will ever have to deal with an audit, although the reality is some of them most likely will, there perhaps is some sort of redeeming benefit to that possibility, which is getting us to have a solid handle on our financial records. And that's a great segue to episode 20.
Completely agreed. And I have to close that episode that's a rare opportunity which I cannot miss. On this one, I actually do need to close that episode by punching Uncle Sam. See you on the next episode, everyone. Thank you.